Just ahead on retirement results, how much risk are you taking with your investments? We'll help you understand it and show you how to take some of that risk off the table. Plus, the 60/40 portfolio may not be so tried and true anymore. We'll tell you why. And put on your thinking caps because another edition of Right or Wrong is just around the corner. Don't go anywhere. Retirement Results starts now. Hello again, and welcome to another edition of Retirement Results with Ford Stokes. I'm Matt McClure here alongside Ford. So Ford, hey, are you ready to help people understand the risks they're taking with their investments this week?
Looking forward to it. Let's go.
Yeah, I am looking forward to it as well. We got a lot to get to, as I mentioned at the very top. First, though, before we kind of get into the meat of it, I wanted to say, look behind us, everyone. If you haven't already, Forbes Finance Council is the logo that you see behind us, one of the logos you see behind us. Mm-hmm. Tell our viewers, if you will, why that's a significant thing.
Well, super proud of the fact that Forbes asked me to be part of their Forbes Finance Council. I get to contribute monthly articles. Also, I provide expert advice with some of their expert panels regarding the subject of retirement and investing and retirement income, and also Social Security as well, and even Roth conversion and other subjects. So it's a pretty neat thing. Lots of folks go to Forbes.com. I encourage people also check out Forbes.com. Really appreciate what they've done to include me in that website. And we're super excited to share more educational information with our viewers here on Retirement Results.
Yeah, very trusted source there, and glad to have you be part of that and be a registered Social Security analyst as well.
Yeah, there's only like 15 of us in the state of Georgia, and I'm like the 7th registered Social Security analyst licensed to work in the state of Alabama. We kind of work in Georgia, Alabama, Florida. That's really our main areas for active wealth management. And I'm not affiliated with the Social Security Administration at all, but I can help people maximize their Social Security income benefit. We use the RSSA Roadmap. It's a portal. People can actually visit rssa.com/QRR. That's rssa.com/QRR, and they can go straight into the portal and get started with their own Social Security maximization report as well. We're happy to provide all those services for free. You and I, as licensed advisors, only get paid when we manage assets, and we want to help people make a sound financial decision on their retirement future by having all the information in front of them so they can kind of plan their retirement in advance.
Yeah, absolutely. Protection and growth is what it's all about. Getting those results in advance also definitely important. And today, the show is all about risk and understanding risk. And we're actually going to get some inspiration from the Oracle of Omaha himself in our quote of the week this time around.
Here's our financial wisdom quote of the week.
And Warren Buffett said this: risk comes from not knowing what you're doing. Ford, what do you think about that?
Totally agree. I think a lot of people that just try to plan their retirement on their own without working with a licensed financial advisor, without a fiduciary like you and I are, and like Sam is, where we put the needs of our clients ahead of our own, where they don't understand their expense ratio, or even what an expense ratio is. They don't understand their standard deviation is a measurement of risk and how much risk they are taking with their assets. They don't have a good, clear picture on the correlation of their assets, how much their assets move with each other in an upward market or a downward market. Just so many things to handle, but also what's going on with Medicare, what's going on with Social Security, what's going on with retirement income, what's going on with tax planning. A lot of people confuse tax preparation, as we're all have been doing in advance of April 15, right? But they don't do the tax planning where they could do Roth ladder conversions and delete the IRS from being their partner in retirement. There's a lot of factors to consider, and we would just ask, why don't you give us a shot to really help you build that successful retirement for you and your family.
Yeah, and all of our viewers can do that by just scanning the QR code that's on the screen. You can also call the number that's there on the screen as well, or go to retirementresults.com. And, for Warren Buffett's quote there, risk comes from not knowing what you're doing. Well, part of knowing what you're doing is understanding what you're paying for your investments. And we'll use the term quite a bit in the financial world, expense ratio. What is that and why is it important?
So an expense ratio within a portfolio are really the internal fees, not necessarily hidden fees. They will share with you what those fees are within a prospectus, but very few people actually read the prospectus on a mutual fund or an ETF. Also, we use ETFs to implement our portfolios because they're a far superior product because they're lower in fees and still give the same diversification as mutual funds do. But an expense ratio is basically the fees within your portfolio that are the leaky hole in the bucket that pull money out of your portfolio that don't necessarily show up on your statement month to month. Example would be with mutual funds, there are things called 12B1 fees, which are marketing fees that the mutual fund companies charge, but there's not a lot of mutual fund companies that actually market at all. They'll take that money and put it in their pocket. So you don't really even get educational value from those 12B1 fees. We like to eliminate those by implementing our portfolios with exchange traded funds or ETFs and try to reduce that expense ratio. Our expense ratio for our portfolios average between like 0.15 to 0.17. When people come in with 401ks, those 401ks have expense ratios of 0.8 and above, sometimes even above 1% a year, where money is coming out of their portfolio. It doesn't show up on their monthly statement other than in the bottom line asset account value of their overall account. That's a real concern, and that's something we need to address early when we work with our prospects and clients.
Another sort of term that people need to understand here that we'll talk about next is standard deviation. Standard deviation is an important factor, of course, that when we talk about risk tolerance and how much risk you're willing to take with your investments. So in plain terms, what exactly does standard deviation mean?
Well, it's a measurement of risk. Also, when we look at risk and return, usually with reward, there comes some level of risk, right? But we like to see a balance between those two. And sometimes we have a lot of people who will come in with 401ks where their average rate of return may be 5%, but their standard deviation is at 12, 13, 14, 15%, where they're risking 3 times as much as they're getting in average annual rate of return. And we want to make sure that we're reducing that standard deviation, so how much they're deviating off the mean and really doing a good job, and also how much they can deviate off the benchmark, whether that benchmark's the S&P 500 or the NASDAQ 100 or the Russell 2000 or the Wilshire 5000 or whatever the benchmark you want to select. We want to make sure that we're not deviating too much off of that efficient frontier of investment. And you've got to keep your standard deviation down. Believe it or not, reducing your standard deviation, which is a measurement of risk, is probably more important than your average annual rate of return.
Wow. And I'll tell you, I'm not a doctor, but I would imagine minimizing that volatility like that, of that standard deviation, probably good for the, the blood pressure and all of the
No question.
cardiovascular things that go on in your body
Right,
as well,
sure.
stress levels and all of that. Well, I mean, here's my question though for our viewers. Do you know your standard deviation in your investments? Well, you can call the team at Retirement Results and the team at Active Wealth Management, and we can do a deep dive into your finances as we take part with you in a free, complimentary, and obligation-free consultation. All you have to do is scan that QR code on your screen. You can also give us a call at the number on the screen or just go online to retirementresults.com. Well, let's take our first break here, Ford, and when we come back, we're going to talk about how different allocation strategies can mean the difference between living the retirement of your dreams or, having those dreams turn into nightmares. We'll be right back.
Scan the QR code on the screen with your smartphone to visit retirementresults.com/plan. That's retirementresults.com/plan. Our team is standing by and ready to start building your successful retirement plan today.
Welcome back to Retirement Results. I'm Matt McClure here with Ford Stokes, our Chief Financial Advisor. And when we talk about investing for retirement, one question people need to ask themselves is how well diversified their assets are. In other words, are they properly allocated? So Ford, I'll ask you, why is that knowledge so vital?
It's really important for people to diversify their investments so they can diversify their risk, because you wouldn't want to take what's called unsystematic risk, right? Where you invest just in one stock. And if that stock were to fail, or that management company or that management team on that company would fail, then all of a sudden you've lost your entire nest egg. Yeah. So you want to really, for me, and for representing our clients, I really like to see us get a lot of diversification so we can diversify the risk away, because we want to kind of take default risk off the table and make sure that, you know, a base level of assets are going to be there. Also, we will implement bond replacement strategies with it too, so that we can protect 40 or 50% of the assets that are income based, where they're not exposed to financial risk at all. So we really look to try to minimize the risk with that diversification. For all our viewers, I would like them to just remember one thing. Diversification is not just diversifying within different stocks and ETFs and mutual funds. You may want to differentiate between different types of products. So you can have some financial products with equities and ETFs, exchange traded funds, or mutual funds, although we recommend exchange traded funds because they're lower in fees. But then also look at some insurance products like fixed index annuities that are there as insurance against you living too long, so that your money can outlive you versus you outliving your money. And also you can look at other products like structured notes and other things that we work with too. But we like to look at different product diversifications and allocations, not just different sector allocations within the equity markets.
Yeah. And there are different methods for asset allocation, right, that people might use, and that the different advisors might use different, methods for asset allocation. Mm-hmm. So let's go through these two main types here, strategic and tactical. Let's tackle strategic first.
Sure.
To not sound too confusing.
Absolutely, no problem.
Strategic asset allocation, what is that?
Well, strategic asset allocation is more of a buy and hold strategy. You want to try to strategically choose, that's where the word strategic comes from. You want to strategically choose the asset allocation. You're going to pick those horses that you're going to ride, you're going to invest with for the next 12 months. For the next 365 days, we're going to buy and hold those assets that are within that strategic asset allocation bucket, and we're going to see how they perform. But we're going to try to pick the assets that we think are going to do the best over the next year, and we're going to implement a strategic allocation where we're not buying and selling every single month or every single week or every single day. We're going to try to buy and hold for the next 12 months and then reevaluate kind of in month 11 and then figure out what we're going to do starting right at the end of the 12th month.
Yeah, and then hitch your horse to that post for the next 12 months.
That's right.
365 days. Mm-hmm. Well, so then compare that with tactical asset allocation. What is that, and how is it different?
Yeah, it's one of the reasons why the name of our firm is Active Wealth Management. We don't like just doing buy and hold strategies. We don't tell our clients, hey, just hang in there.
Set it and forget it, right?
Yeah, so many of our viewers, when they come to meet with us, and you've met with so many clients too, Matt, where their advisor has told them, hey, just hang in there. And if our viewers have heard just hang in there, like say 2022 or even 2008 to 2009, like from March 2008 to March 2009, the S&P 500 lost 50.1% of its value. It was probably difficult for people to hear, hey, just hang in there from their advisor when they saw their portfolios erode. Tactical asset allocation is tactically rebalancing on an ongoing, regular, consistent basis. We like to reallocate about on a monthly basis. We reassess and we look at the allocations over the next 6 months, which asset classes are going to do better over the next 6 months, and then reallocate within that month to do that. Now, we don't wholesale reallocate every single month. We also don't get paid on commissions. So we don't want to churn people's accounts. We only get paid a flat fee to manage our portfolios with advisory and portfolio fees together and combined. And we're generally below what we see from other wirehouse firms. And we're not a wirehouse firm. We're a private wealth management firm. But with our registered investment advisor firm, Brookstone Capital Management, we've got over $8.5 billion under management. So we're still big enough to be able to handle the needs of our viewers within our community. But we want to do everything we can to implement a combination between strategic and tactical asset allocation that allows our investors to protect from downside risk first, and then hopefully get a higher average annual rate of return, and they can get just implementing it themselves, hopefully.
Yeah.
And hopefully you see a really great result over time.
Yeah, and that's what we see by and large is a great result over time for clients. And the whole kind of takeaway, I think, from a lot of our discussions today is the old 60-40 portfolio might not be so tried and true anymore, as I said at the very top of the show, because, you don't want to necessarily just have your 60-40 portfolio, you buy it, you set it and forget it, like you said, and you walk away and wash your hands of it and think that everything's going to magically turn out okay. Unfortunately, life is not magic. So
Right.
there is that.
Right. Well, I'll just say Harry Markowitz was given credit for being the founder of modern portfolio theory in 1952. I mean, that's 72 years ago. And I would just ask our viewers, do you really want to stick with a 72-year-old strategy or want to consider something new? I mean, so many people are like, hey, should I invest in crypto? Should I invest in physical gold and silver? What should I be doing? And all those kind of things. But I will just say this. You really should consider a bond replacement strategy. And this, you mentioned the 60-40 portfolio. So here's what Harry Markowitz did. He said, with modern portfolio theory, if you take 60% stocks and 40% bonds, you should get an efficient investment frontier between the two markets. They're both traded in U.S. financial markets, both stocks and bonds are. And then as money rushes out of stocks when the markets are down, it should rush into bonds. The problem is in 2008 and also 2022, we didn't really see that. And in fact, 2022 was the worst year for the 60-40 portfolio in 41 years. Mm-hmm. And I would just ask, do you really want to continue with that type of eroding strategy? The 60-40 portfolio has had really tough years the last 3 years. If you'd have been 40% fixed index annuities and 60% in ETFs and stocks, you would have fared much better.
Yeah. And if you want to make sure, folks, that you are properly allocated in your investments, if you've got that old 60-40 portfolio, things haven't been going as well as you had hoped that they would, just give us a call. The number is right there on the screen. You can also call us by going to the website, getting the phone number there. The website is retirementresults.com. And you can also get to that website by scanning the QR code that you see on your screen. Well, stick around. We're going to take another break here. But when we come back, we're going to put our words into action and tell you how we recently helped out a client and help them achieve their financial goals and saw them through a problem. Yeah, it's our problem solver segment when Retirement Results continues. Welcome back to Retirement Results. It is time now for our problem solver segment, where we will tell you how we've been able to help other viewers of the show as they plan their financial future.
And now our problem solver for the week.
All of our problem solver segments here, we change any of the names and personal details to protect the identity of those individuals involved. Kind of like Dragnet, we want to protect the innocent here. So I'm going to set up our problem this week for you, Ford, and it's got to do with a gentleman named Peter who turned 70. His wife, Rose, does not work. Peter still works. His wife, Rose, does not. And she's ready for him to retire, though, right? I mean, she wants him at home, spending more time with her. Rose wants to travel as well, but she's concerned that they don't have enough saved to retire the way that they want to retire. He's got $900,000 in a 401k. The couple would receive $4,800 a month combined in Social Security. So that is the scenario here for Peter and Rose. What's the solution for it?
Well, the solution is try to take 40% of the assets or 40 to 50% of the assets and place that into a fixed index annuity and get him a higher average annual rate of return, but also get him a higher income level and income payout ratio to be able to satisfy those needs. They also, they prioritize legacy down further, and they prioritize their own retirement and their own lifestyle up higher. So they were willing to do that. But also they want to be also in a fixed index annuity where the average annual rate of return can outpace the withdrawal rate, so their account value doesn't go down as well. And we help a lot of people get in products just like that.
Yeah, that's great. A great solution there for them. And, we want to make sure with all of our viewers and clients that they don't run out of money before they run out of life. That is the entire goal here. And great that we're able to do that and help them meet their retirement goals. That's Peter and Rose. And listen, folks, if you have a situation that maybe it's similar to Peter and to Rose and their situation, maybe it's completely different. And you say, I got to have some real advice from professionals here so that I can make the proper decisions to set me up for success in my retirement years. Well, all you have to do, it's right there under your nose, okay? It's our QR code that you can scan there on the screen. It's also the phone number that's on the screen, or just go to retirementresults.com. All right, one more segment to go, and it is everybody's favorite. It's Right or Wrong. It's coming up next as we welcome in Sam Davis to lead us in that. Stick around, much more Retirement Results coming up.
Scan the QR code on the screen with your smartphone to visit retirementresults.com/plan. That's retirementresults.com/plan. Our team is standing by and ready to start building your successful retirement plan today.
Welcome back to Retirement Results. I'm Matt McClure here along with Ford Stokes, and now we're joined by our very own Sam Davis as he leads us in another edition of Right or Wrong. What conundrums do you have for us this time around, Sam?
Yeah, well, happy to be here today. You and Ford are talking about how to grow your portfolio. So I'm here to review some of the most important themes that you've already discussed today. Starting with Ford, is this right or wrong? When it comes to your IRA, 401k, or any other retirement plan, the best strategy is to set it up, forget it, and just keep saving. Is that right or wrong?
That's absolutely wrong. The people that just hang in there, they really lost a lot of money in between March 08 and March 09, as we talked about earlier on the show, when the S&P 500 lost 50.1% of its assets. So you really don't want to ride all the markets all the way down to the bottom of the valley. You want to really try to reallocate and reevaluate and trade your account and make sure that you don't just ride those big, huge loss curves down to the bottom of the valleys of the market. You want to make sure that you're adjusting and you're not just hanging in there with your investments. You're actually tactically and actively managing your wealth and having somebody do that for you. And here at Active Wealth Management, we'd love to do that for them.
Yeah, it's such a great point. That's one of the reasons why we call our firm Active Wealth Management, looking out for people regardless of what happens. All right, Matt, this next one is for you. Right or wrong, you can delete fees on the bonds you currently hold in your portfolio by replacing them with an investment that offers market-like gains without the market-like risk.
Well, that is absolutely right. You can do that. It's a product that we use a lot called a fixed indexed annuity, and it does give market-like gains without the market risk because your money is tied to an index that is linked to a market, right? So it follows the movement in a particular market index. But if that market index goes down, you don't lose a penny over that whatever period, that the crediting period that you have. So your principal is 100% protected inside that particular vehicle, but you can get those market-like gains, and they don't come with nearly the fees that those bonds do. So yeah, absolutely, you can get exactly what you just talked about.
Yeah, and that's great news for our viewers. We're doing a lot of talking today about how to grow your portfolio. That is a great tool when it comes to protecting your portfolio, but it also offers some great growth as well. Ford, I've got one more for you. From a fee perspective, ETFs or exchange traded funds are far superior products than compared to mutual funds. Is that right or wrong?
Well, it's really strong language to say it's far superior, and it absolutely is right, because ETFs are lower in fees, much lower in fees, because they don't have 12B1 fees, they don't have A share fees, they don't have C share fees. They also are traded within the intraday of the trading day, whereas with mutual funds, you have to wait till they can assess the net asset value of the mutual fund shares at the end of each trading day, and then you can buy or sell shares in mutual funds. So I would strongly urge everyone to consider implementing their portfolios with exchange traded funds versus implementing them, which is the typical 401k plans, with mutual funds. And again, it's a good time to say, hey, you know what? If they've got that 401k, we can provide a 401k review at no cost to them. All they got to do is call the phone number on the screen, or click the QR code as Matt says. And then also they can just visit retirementresults.com, click that schedule a consult in the upper right corner. We're happy to help them.
Yeah, well, we're so glad to be back again this week, helping all of our viewers not just protect their hard-earned money, but grow it as well. That's really been the focus today. But thanks for having me back.
Yeah, no worries. Thanks for being back. You're part of the team and we're glad to have you. And if you at home would like to schedule a free consultation with any of us here at Active Wealth Management and Retirement Results, you can do that very thing. Each one of us are licensed financial advisors and we'd be glad to help you out. All you have to do is, as Ford said a little bit earlier, just go to your screen right now, grab that phone, point it at the screen and scan the QR code. You can also go to retirementresults.com or call the number that's right there on the screen as well. Well, that's going to do it for this time around here on Retirement Results. That is all the time that we have left this week, but we'll be right back here next week. So we'll see you then. For Ford Stokes and Sam Davis, I'm Matt McClure. Thanks so much for joining us, and we'll see you next time.
Visit retirementresults.com/plan. Our team is standing by and ready to start building your successful retirement plan today.
Ford Stokes and Active Wealth Management are not affiliated with or endorsed by the Social Security Administration or any other government agency. Information provided is not intended as tax or legal advice and should not be relied on as such. You're encouraged to seek tax or legal advice from an independent professional. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims-paying ability of the issuing company and are not offered by Brookstone. Any bonuses mentioned may be subject to additional restrictions and regulations based on the offering annuity company. You may not receive the bonuses if the contract is fully surrendered or if traditional annuitization payments are taken. And if the policy is partially surrendered, it could result in a partial loss of bonuses. Because these are bonus annuities that may include higher surrender charges, longer surrender charge periods, lower caps, higher spreads, or other restrictions that are not included in similar annuities that don't offer a bonus feature.